Hello, this is Nick Rach with the Earnings Scout, and today I'm going to review the earnings estimate revision trends for Goodyear and determine if this is a stock you want to own or not. The first thing I'm going to show you is a starting point for our analysis that we use at the Earnings Scout, and this is our proprietary measurement of Goodyear's earnings expectation changes over the past 2 years. Now we look at multiple time periods here, but we're just going to show you the 2-year trend here for now. The blue line on the screen is measuring how earnings expectations are changing for Goodyear. The red line is the price. So you can see on the chart here, 2 years ago, Goodyear was trading at $20, and the stock price, while not going up in a straight line, has appreciated almost 45% in value over the past 2 years. So it's done very well. So as we look to evaluate Goodyear, if you've been in the name, do you keep owning it? If you haven't been in the name, do you want to buy it? Or if you have been in the name, is it time to sell? So these are always the key questions investors always want to know. Today we're going to look at the earnings estimate revision trends to determine that answer. So as we begin, the first thing we could do that we do at the Earnings Scout is make this very, very easy for clients. So we're going to explain the logic to earnings in a little bit, but if you just wanted to save time and realize we do all the math and calculations and evaluation for you on these earnings trends, we're going to show you that the ES indicator score up on our screen here is a 65 out of a possible best for Goodyear. So we're going to circle that. That means it's a hold in our system. Anything with indicator scores between 21 and 80 in our system, we think it's okay to hold. Obviously, the lower the number, the weaker the hold that we say for a stock. But we want to tell you that 65 is pretty good. In our system, if you have a process that likes the stock, 65, you can continue to own the name. Now, why don't we have a higher score for Goodyear? I'm going to show you that it has decent earnings revision trends, but there are some inconsistencies in here. So if all you want to see, whether to hold or not, continue, that's all you need to know. If you want to learn more about how we derive that 65 indicator score, follow along. So what we're going to show you here, we said the red line is measuring the price. The blue earnings scores on the chart. So you can see here they're a little bit jagged. There's no real pattern to them that we could see, but we're going to show you there actually is a pattern. Those are measuring Goodyear's earnings estimate changes from the analyst. 6 months to 2 years out into the future, and then we measure those each week and then plot how they're moving on a percent basis. So the line I'm going to draw in here is at the 0 line, and above the 0 line, that means earnings estimates are going up on an absolute basis. Below that line, that means the estimates are going down. The score, the earnings score itself, will tell you the magnitude by which estimates are rising or which they're falling. So I'm going to flash on the screen here the most latest read on Goodyear's earnings score, and you can see it's near 6.47%. That's a proprietary blend that we calculate. We're going to show you how we come up with that logic by looking at the Q1 estimate change for Goodyear. Now the Q1 estimate for Goodyear represents its December 2016 quarter, and at the end of September that estimate was for $1.03. Now if you go back in time 90 days, the estimate was 95 cents. That is an 8.47% jump in the earnings estimates. Now, to get an earnings score, we're using multiple periods, multiple times frames to look at, so multiple quarters, multiple years, over 30, 60, 90, 120 days, all these estimates in a proprietary blend. But if we were only using the Q1 estimate change, and that's what you see on the screen here for the December quarter would represent the Q1, the earnings score, for the sake of simplicity here, would be 8.47%. Now, why do we not only use the Q1 estimate change? Because companies, that may not be reflective of its overall expected profitability. That's why we blend these over multiple quarters, multiple years, over multiple time frames to try to get an overall blend that we would have. Because when we look at the fiscal year 17 estimate for Goodyear, you could see the analyst 90 days ago thought it was going to be $4.16. They raised those. The consensus estimate has come up to 437. We're 5.04% range. And you can see roughly how we're getting that earnings score at that 6.47%. So what it's saying is the overall expected profitability for Goodyear is going up by almost 6.47%. This is going to be key as we determine whether expectations are getting better or worse. We don't care if estimates are going up or down. We care if the expectations are getting better or worse. It's key to understand that. So when you look at Goodyear, were the estimates getting better or worse? In towards the end of 2014 to the beginning part of 2015, the estimate trends were weakening. They were going to where the estimates were being close to maintain, to where they were getting cut at a rate of 17.41%. And then the estimate trends start to get cut at lesser and lesser rates. And then the trend goes back up, only to see the trend reverse back, and then the trend come back up in the general direction. So while there's inconsistencies here that we measure, the overall trend over this past 2 years for Goodyear has been generally improving. Inconsistent, but still gradually improving. So this is why we say it's okay to hold the stock, but this is never going to be a straight line up, because Goodyear has its moments where it starts to show weakening trends and then it gets better. We do like the overall trend across the longer term horizon, that 8 quarters, getting better. But that's a reason why we don't like the stock more. So if we had to use a baseball analogy when it came to Goodyear stock, we would say it's a good pitch to swing at. You can own the name. It's not a perfect pitch to swing at. And we can wait around for the perfect pitch to swing at. And that's what we're looking for. Companies that would have more consistently improving earnings, and one that hasn't been up 45%. That wouldn't be reflective of that. Now, we would like Goodyear a lot more if it was doing these improving earnings trends, and if the stock was down 45%. That we would see that negative correlation and divergence, and we'd want to buy those improving earnings at a cheaper price. But what you got here is a stock with improving earnings over the past 2 years that is fully reflective of that. Now, we're going to keep riding and saying it's a good quality company going in the right direction. It's a good one to own, but there's certainly better pitches to swing at. So hopefully you liked our review on Goodyear. If you want to learn more about any of the 4,500 companies we cover and do analysis on those for any of those companies as we rank all of these, we also do this for every sector and industry as well too, and rank all of those accordingly based on this logic. This is important information to know on earnings. Again, it doesn't matter if earnings estimates are going up and down, and we are the only ones who are going to show you consistently improving earnings or decelerating earnings, and the ones most importantly are going to be sustained into the future. So reach out to our sales and marketing team here at the contact information, or contact us at sales@earningsscout.com, and we'd be happy to do analysis for you. Happy trading. Have a good one. Bye.